Hello friends, hello students. Shares, not a new topic for all of us. We come across this topic in our day-to-day life. You keep on listening from your parents in social gathering. They bought this share, Infosys share, the price has gone up, Tata's price has gone down. In recession, their overall wealth is affected because of the shares. So shares is not a new topic at all. And moreover, you have already studied in 12th standard too. Share capital transactions you have already studied. So today we take up with second year BCom semester 1 higher financial accounting subject. In unit 1 the second chapter is share capital, and this lecture we are going to deal with entry of issue of shares. When a company comes up with IPO, a new company comes up with IPO, initial public offering, at that time what accounting entries are to be passed by the company, those entries we are going to study today. However, before we take up with those accounting entries, have a glimpse at a small trailer of a particular movie. You'll enjoy it. See that?
सपने मत देखो, मुझे टाइम नहीं पहनना है, ये प्रमोशन भी नहीं चाहिए। सपने कभी सच नहीं होते। बहुत हो गई पूरी सपने नौकरी, अब खुद का धंधा हो गया। मेरा बापू कहता था, लेकिन मैंने सपना देखा। धंधा करना चाहता हूँ कपड़े का। 20 साल से इसी जगह धंधा कर रहा हूँ। तुम्हारे जैसे 25,000 रोज आते हैं। गाँवटी देहाती नहीं चलेगा। समझे? चल 1350। हाँ लिया ना साहब। ठीक, आपके बगल में खड़े रह के धंधा करूंगा और आप जैसे 25,000 की छुट्टी कर दूंगा।
See the guts of this man? My God. And it really became the biggest company of not only India but even in world. It has a good recognition.
नाम क्या था तुम्हारा? था नहीं, है और रहेगा गुरुकांत देसाई। गुरु भाई से लड़ना तो गुरु भाई बन के, लेकिन गुरु भाई एक ही है।
So, all of you must have definitely seen this movie, Guru. Which character this Gurukant Desai had played? Yes, you're right, Dhirubhai Ambani. And which company they were talking about? This Shakti name was used in the movie. Which company were they talking about? Reliance Industries Limited. Reliance Industries Limited started in 1975 with a capital of, and today it's a giant company with a capital of 6,388.7 crores. Imagine, almost 6,400 crores of wealth with that company today. Now, why is this been possible? Because single person did not contribute the money. Do you think Dhirubhai Ambani had 6 crores at that point of time? He used to sell saris and clothes on his cycle, but he accumulated this money from the public, from the company, by forming a company. And that is what we are going to study in this chapter. How to form a company, how to accumulate money from the public, and then how to pass the accounting entries when you collect the money for these shares. So, all these giant companies which we talk about, you must have been definitely knowing about Infosys, Wipro, Tata Consultancy Services, Tata Seeds, and then these shares. The share market, how the price goes up and down constantly. All this you have already studied and already you know about these companies. So these companies have not become big because the promoter or the owner had brought enough of capital, but they had become big because they accumulated huge money from the public and became capable to reach to this particular level. Now, 2 is a company, 3 is a crowd, right? We keep on using this statement in our day-to-day life, that 2 is a company and 3 is a crowd. No. When you talk about a joint stock company, 2 is a private company. Private company like Honda, Activa Honda, all of you must be using it. Now, it's not a public company, it's a private company. And the company's name is Honda Motorcycle and Scooter India Private Limited. In Private Limited, we write PVT Limited. And 7 is a public company. Means a public company like Hero Motocorp. So Honda is a part of that Hero Motocorp company, which is actually a public company. Now when I say 2 is a private company, means to start or establish a private company, minimum 2 members or shareholders are required. And maximum can go as per the new laws up till 200 also. But for a public company, minimum 7 members or people are required to form a public company. And maximum there is no limit. Okay, maximum there can be infinite number of shareholders. So henceforth when we talk about a company, we'll not say 2 is a company and 3 is a crowd. What will we say? 2 is a private company, 7 is a public company. Okay, minimum 2 members are required to start a private company, and minimum 7 members are required to start a public company. Now there's an amazing fact which I would like to share with all of you. If anyone would have bought or purchased 100 shares of Infosys at the time of IPO, initial public offering, that means in 1993 the company came up with an IPO of 95 rupees per share. Means if you would have purchased 100 shares of Infosys at that time, you would have invested how much? 100 into 95, 9,500 only. Now during these years, 1997, 2004, 2014, 2018, in between 94, 99, 2006, 2050, company has been giving bonus shares. Bonus shares also will be studying in the coming chapters. After this chapter 1 issue of shares, we'll study bonus shares in the next chapter. So if you count the total shares with you, including these bonus shares, then 100 shares which you purchase with the bonus, they become 1,02,400 shares with you, because 100 shares become 200 in 1994 with 1:1 bonus, 200 become 400 in 1997, then in 1999 they become 800, in 2004 6,400, and so on. By 2018 you have 1,02,400 shares with you, and looking at its present market price, you know what is the wealth you own? 72,396,800. Okay, that means 72 crore 7 crore 23,96,800. 9,500 which you invested in 1993 becomes 7 crore 24 lakhs approximately in 2018. You're a billionaire. You're a millionaire. And annual dividends what you earn right now is 17,92,000. Imagine, you don't have to do anything. Sit at home. Corona, no matter at all. Yearly you earn almost 18 lakh rupees of dividend from this company. All this is power of public. Pooling the funds together, the power of coming together results into so huge, massive benefits for each and every person who is a shareholder. So, as I discussed, coming together, you can see on the screen, all people joining hands together mutually benefit for everyone. Let's understand the concept of capital, share capital and shares in detail. See, capital's term you very first studied in standard 11. Sole proprietorship we used to study in standard 11. First chapter of accountancy. Very first term you came across was capital after business transactions. At that time we studied capital is the amount brought by the owner of the business. So, in sole proprietorship, what you call it as a capital, simply capital. In partnership you studied in standard 12, you call it as partners capital. And now when we talk about the same capital for a joint stock company, it is called share capital. What is the meaning of the word share? Share means participation. In general term, you use this. In general day-to-day life, you use this term. What is my share in this? What is my participation in this? So, since in this capital of a joint stock company, huge number of people participate, share the money, it is called share capital. And each unit which everyone holds in that capital of the company is called share. So, what is share capital? Capital of a joint stock company is called share capital. Yes, I repeat. The capital of proprietorship firm is called simply capital. Partnership firm is called partners capital. And for a joint stock company, same capital is called share capital. Because many people share a participation in that capital, it is called share capital. This capital is contributed by large number of persons called as shareholders, which contribute small amounts. Okay, in that Gujarati there is that proverb "Tipe sarovar bhara," something like that. So everyone contributes small amounts and results into a large pool. The capital is divided into several units of equal and small denomination, and each of this is called as a face value. Normally a face value of one share is 10 rupees. So people contribute 10 rupees, lakhs of people contribute 10 rupees and results into crores of capital. Each of such unit is called share. So every unit which you buy of 10 rupees, that every unit is called share. That is your share, participation in the capital of the company. So each individual units of 10 rupees are called as shares. I hope everyone is clear with it. Okay. So let's see that once again. Capital for a joint stock company is called share capital. And this huge capital is divided into several units of equal value, generally 10 rupees. Each of this unit is called as share. Now, what are the different classifications of share capital we understand in detail? One is authorized capital. Now, authorized capital means what? Authority. You understand authority? You are authorized only for this one. You cannot cross your authority. Your authority in general day-to-day life, you have, if I say that a teacher is given authority to punish a student, then he can punish. If a teacher does not have authority to punish a student, he cannot. So authority is the limit, restriction. Now when you form a company, then you make memorandum of association. You obtain certificate of incorporation. So in that memorandum of association, you have name clause, object clause, capital clause, domicile clause. Several clauses are there. One of the clauses, capital clause, you mention this authorized capital. So suppose you mention that your authorized capital is 2 crores. Then you're authorized to collect only 2 crores from the public throughout the life of the company. Now Reliance started with initial authorized capital of somewhere around 8 to 10 crores only. Time to time it has changed its memorandum of association, increased its authorized capital as and when the money was required. But initially you come up with an idea that I want to start this company. I am sure I will not require more than 50 crores for the next 5 to 10 years. So you mention in memorandum of association that authorized capital may be 50 crores. More than 50 crores you cannot collect until you amend, you change that memorandum of association. So authorized capital is the authority given to you to collect the money. More than that, there is a restriction, you cannot collect. Next, issued capital. Now issued capital means what? Out of this authorized capital, say 50 crores I decided I'll require for the next 5 to 10 years. But when I start a new company, first year, then I require maybe only 10 crores to start the company. So I'll not accumulate entire 50 crore at one go. So initially I plan that I'll collect 10 crores from the public and I offer, issue means remember offer. I offer to the public shares worth rupees 10 crore, that is my issued capital. So what is issued capital? It is a part of authorized capital. Authorized capital 50 crores, a part of that 10 crores. Issued capital is a part of authorized capital which is offered. The issued, remember offered, okay? Offered or issued to the public. Now next we go with subscribed capital. Now I offered 10 crore to the public. There are 3 things possible. 1, overwhelming response. Means I offered 10 crore, people are dying to buy my shares. So I receive the number of share applications from the public worth 15 crores. This is called oversubscription. Okay. Second, I offer 10 crores of shares. People also buy exactly ditto to ditto 10 crore shares only. Not a single share more, not a single share less. Practically impossible situation in the world. This is called full subscription. Offered, issued 10 crores, people applied for 10 crores, subscribed 10 crores. And third, I offered 10 crore of shares and people purchased 9.5 crore of shares. Poor response. Like presently depression is going on, people don't have money to invest. So maybe I get poor response if I offer 10 crore of shares, only 9.5 crores may be applied by the public. This is called under subscription. You offered or issued 10 crores but you received poor response. Less applications are received. So remember, three things are possible when you issue the shares. Either there can be oversubscription, good response, or there can be full subscription, what you offer exactly same number of applications you receive, or there can be under subscription, poor response. Now here you have to remember that minimum subscription has to be 90%. Okay, this you would have studied in 11th standard. If you don't receive at least 90% of money from the public, you don't deserve to start the company. So as per the Companies Act, this restriction has been imposed. If you offer 10 crores and you don't receive minimum 9 crore of applications from the people, you cannot start the company. You have to refund the money, whatever is received, that also. So issued capital's part, which is applied by the public, is called subscribed capital. Okay. So what is subscribed capital? It is that part of issued capital which is subscribed or applied by the public. And if there is oversubscription, you have to refund. So if you receive 15 crore of shares, you cannot keep whatever you receive. 5 crores of money you have to refund, and your subscribed capital will become equal to issued capital, that is 10 crores only. I repeat, if there is oversubscription, you offer 10 crore of shares, but you receive 15 crore worth of shares, you cannot keep 15 crores with you. 5 crores you have to refund back to the public, and because you needed only 10 crores, so you offered only 10 crores, you cannot take more than that. And what will remain with the company is only 10 crores. In short, subscribed capital cannot exceed issued capital. Okay, so subscribed capital will always be equal to or less than issued capital if there is under subscription. Okay, so subscribed capital is that part of issued capital which is subscribed, means applied by the public. And what we are supposed to do when there is oversubscription? Refund the money. All these concepts will be helpful when we take up with the journal entries. That's why I am discussing this. So at that time, you'll come across the situation of oversubscription also and under subscription also. So when we pass the entries, you need to remember, when there is oversubscription, you have to refund the money. Okay. Next, called up capital. Now, called up capital means, as I said, face value is 10 rupees. Now, this face value of 10 rupees can be called in 3 different installments. First installment is called application money. The money which the public pays along with the application of shares is called application money. Second is called allotment money. After they apply for the shares, you make allotment of shares to them. Allotment means you confer, you give them the shares. When you give them the shares, at that time, again some amount they have to pay, which is called allotment money. And after that, whenever you need the money, you can call from them. Whenever you need the money, you can call from them. So it is called call money. So this 10 rupees of face value can be called in 3 installments. Application, allotment, call money. Okay, what is called up capital? Suppose I decide 10 rupees of face value, 3 rupees I'll collect with application, remaining 3 rupees I'll collect with allotment, so 3 plus 3 is 6, and 4 rupees I'll collect with call money whenever I need it. Now in the beginning, I collect 3 rupees with application. After 3 months, I collect 3 rupees of allotment at the time of making the allotment of shares. So what have I called up from the company, or sorry, from the public after 3 months period of time? 3 plus 3, 6 rupees. This 6 rupees is called up capital. Okay, so if 1 crore shares are offered to the public and out of 10 rupees I have collected 6 so far, then my called up capital will be 1 crore into 6 crores. Say authorized capital 50 crores, issued capital I offer 10 crore shares worth to the public, so 1 crore shares of 10 each 10 crores. Subscribed capital, let us say I received under subscription, so I received 90 lakh shares of 10 each 9 crores. Called up amount, I called from them 6 rupees so far. So 90 lakh shares into 6, called up capital 5 crore 50 lakhs. Now paid up capital, you called 6 rupees from them, but you'll come across some odd man out people who may not pay you the money. So maybe some people don't pay that allotment money of 3 rupees. Let us say there is one shareholder holding 50,000 shares who did not pay 4 rupees of allotment money. So he did not pay you 50,000 into 4, 2 lakh of rupees. This 2 lakhs is called calls in arrears. All these terms will be helpful later on, okay? You can note down when you are listening to this video. What is that 50,000 into 4 rupees, sorry 3 rupees, okay 4 rupees, so let's say call money is not paid by a person. So what is that 50,000 into 4 rupees, 2 lakhs called as calls in arrears, okay? That means what is paid by the public from 5 crore 40 lakhs, I did not receive 2 lakhs, or let us say 3 rupees I am talking about allotment money, I did not receive 1,50,000. Then what is my paid up capital? What is paid by the public out of that 5 crore 40 lakhs? 5 crore 40 lakhs minus 1,50,000. 5 crore 38 lakh 50,000. That is paid up capital. So you'll see this chain is established. Issued is a part of authorized. Subscribed is a part of issued capital. Called up is a part of subscribed capital. Same way paid up is a part of called up capital. What is paid up capital? It is that part of called up capital which is paid by the public. We called up how much? We called up 5 crore 40 lakhs. Out of that, one of the shareholders did not pay how much? 1,50,000. So what is paid by the public or the shareholders? 5 crore 40 lakhs minus calls in arrears of 1,50,000. 5 crore 38 lakh 50,000. That is paid up capital. So it is that part of called up capital which is paid by the public. Okay. Now, authorized, issued, subscribed, called up and paid up we are required to write in the balance sheet of the company. Okay, these 4 capitals we are required to mention in the balance sheet of the company. Rest of the 2 are only for understanding, but we don't mention them in the balance sheet. So what is this uncalled capital? Now, again don't make a mistake. Issued is a part of authorized, subscribed is a part of issued, called up is a part of subscribed, but paid up is a part of called up. But uncalled is not a part of paid up capital. Now see, I discussed that of 10 rupees, okay, out of 10 rupees, company called only 6 rupees. Out of 10 rupees, company called only 6 rupees. What did the company not call? Remaining 4 rupees. That is called uncalled capital. So called up and uncalled both are a part of subscribed capital. Subscribed capital divided in 2 parts. 6 rupees called up, 4 rupees not called. So 6 is called up capital, 4 is uncalled capital. So that 90,000 into 6, 5 crore 40 lakhs is called up capital, and same 90,000 into 4, 3 crore 60 lakhs is uncalled capital. Out of 9 crores, called up is 5 crore 40 lakhs, uncalled is 3 crore 60 lakhs. But uncalled capital we don't have to mention in the balance sheet. Now what is reserve capital? See, reserve is a normal term. In accounting, it's not a new term for you. Reserve means you save. So reserve capital means it is that part of uncalled capital which you decide never to call except when the company goes into liquidation. So you reserve that money, that when difficult times come, then only we'll ask this money from the shareholders. Okay, that is called reserve capital. So suppose 4 is uncalled, 2 years over, 3 years over, 10 years over, the company is cash rich and doesn't require the money only. The company may decide that from this 4 rupees, 1 rupee we will call from the people only when we go into liquidation. That 1 rupee 90 lakhs into 190 lakhs will become reserve capital. When are the shareholders supposed to pay that 1 rupees now? Only when the company goes into liquidation. So reserve capital is that part of uncalled capital which will be called only when the company goes into liquidation. Okay, let us recapitulate it very fast. Authorized capital is mentioned in memorandum of association. and more than that shares, company cannot issue throughout its lifetime. If they want to issue more shares, they have to change their authorized capital in memorandum of association. Issued is a part of authorized capital which is offered to the public. Remember, issued, offered. Subscribed is a part of issued capital which is applied by the public. Remember, subscribed, applications received. Issued, offered, subscribed, applications received. Called up is that part of subscribed capital which is called by the company. So 10 rupees can be called in installments. If less money is called, then that much will be called up capital. From called up capital, when you minus calls in arrears, the money not paid by the shareholders, we get paid up capital. I repeat, from called up capital, when you minus calls in arrears, we get paid up capital. Uncalled is again a part of subscribed capital which is not called by the company. And reserve is a part of uncalled capital which company decides to call only when it goes into liquidation. Okay. Authorized, issued, subscribed, called up and paid up capital are to be mentioned in the balance sheet. Uncalled and reserve capital is not to be mentioned in the balance sheet. Let's go further. So next what we see is accounting entries. All of you can take out your notebooks, and by that time we'll go with the accounting entries part. So we'll take up with the accounting entries of issue of shares. Basic concepts we already understood in the previous part. Whatever you are watching in this video lecture, you have to write it. Okay, I repeat, listen the instruction carefully. Whatever you are watching in the lecture, this part of the lecture now, you have to write it. I will be going in a gradual and slow pace so that you can write it along with me, or else you can pause the video, write it, and then you can play it again. You can keep doing this during this lecture. Okay, so all of you give the heading in your notebooks, issue of shares. Now, see everyone, shares can be issued in two different ways. Okay, one is for cash and the other is for consideration other than cash. Now understand what are these two. See, for cash means you give the shares, you get the money. You don't really get hard cash. You directly get the money in company's bank account. Okay, you directly get the money in company's bank account. So you offer the shares, you get the money in your bank account. We say shares are issued for cash, money. Now for consideration other than cash means, for example, say you buy a machinery. Okay, you buy any asset, say machinery. The payment of that machinery you make in terms of company's shares. So what are you giving or offering? Your shares. And against that, what are you getting? Not cash, you're getting machinery. That is consideration other than cash. Today we will be studying only the first part, that is issue of shares for cash. Now both of these can be further issued either at par or at premium. Now at par means they are issued at an amount equal to face value, and at premium means more than face value. Okay, so generally the face value of share is 10 rupees. If they are issued at 10 rupees itself, we say they are issued at par. And if they are issued at more than 10 rupees, say rupees 12, 15, 20, we had issue of demand in past which was offered at 450 rupees. So whatever is collected over and above 10 rupees is considered to be premium. Like here 12 rupees, so 2 rupees is premium. Both these entries we will study today. All of you can give the heading now, we take up with the first one, issue of shares for cash. Okay, issue of shares for cash. And in that we take up with first situation, that is at par. Now, we studied in the previous portion today that you can collect the money in 3 installments. Okay, face value can be collected in 3 installments: application, allotment, and call. So there are 6 basic entries: 2 entries of application, 2 entries of allotment, 2 entries of call. Now, first entry what we have to pass is on receipt of application money. Okay, I hope everyone is writing it. Keep writing it. On receipt of application money. Now, very first, people will apply for the shares. They will pay application money, first installment. So, from company's point of view, bank is the receiver, debit the receiver, bank account debit. And temporarily, all of you listen carefully, temporarily, since it is application money, we transfer it to an account called share application account. Okay, temporarily we transfer it to an account called share application account. So once again I repeat this entry. Bank is the receiver, debit the receiver, bank account debit from company's point of view, and temporarily we transfer this money to share application account. Okay, I hope everyone is clear with that. Now, second entry is on allotment of shares. Now listen carefully, this allotment of shares here we mean offering of shares was done at the time of application. Now allotment means we really give them the shares, confer the shares to them. So when they apply, they are public. Now once we allot the shares to them, then they will become the shareholders of the company. This allotment is not that allotments installment. Both these entries what we are passing for application installment only. Okay, both these entries are for application installment only, but when you receive the applications, then you have to give them the shares. When we give them the shares, we say shares are allotted to them. So at that time, what entry to be passed? Now once we allot the shares to them, then we can consider that money as the capital of the company. Now we have given them the shares from public, they have become shareholders. So now we can consider that it is the capital of the company. So this share application account what we credited, we will close and debit. Share application was credited earlier, so we will close and debit. Reverse to close it. Share application account debit. And now we can consider it as the capital of the company. So we transfer this money to share capital account. Okay, now we can consider it as the capital of the company, so we transfer it to share capital account. So this allotment is different from the installment of allotment. Here when we say allotment of shares, means we just mean to say that we are after offering the shares, now we are conferring or giving them the shares and making them the shareholders. Now we studied that there can be 3 situations: full subscription, under subscription, and over subscription. So what did we discuss? If there is over subscription, people apply for more shares than what we offer them. I told you we cannot keep entire money what we have received, we have to refund the money to them. So here that situation will arise. If there is over subscription, then we will refund the surplus application money. So here company's bank will become the giver, credit the giver to bank account. In bracket mention refund. For the refund amount we have to credit bank account. So these two entries are related to application. Okay, first we receive the money, so bank account debit to share application account. Then once we allot them the shares, we make them the shareholders. Share application account will reverse and debit and close, and we transfer it to share capital account. And at the same time, if there is oversubscription, then we refund the surplus application money so to bank account. Okay. Now, second installment is allotment. Now we are talking about the installment of allotment. So as I said to you earlier also, as and when the company needs the money, they will ask the money from the company. So after application, now company will ask for allotment money. So on allotment money due. Now here we are talking about the allotments installment. Okay. This allotment was simply giving the shares to the public. Now we are talking about allotments installment after application, which we have to collect. So on allotment money due. Now see, until application money, they were public. After allotment, now they become shareholders. Now since they have become shareholders, it has become their liability to pay 10 rupees to the company, up to 10 rupees. As we say, limited liability company, their liability is limited to 10 rupees. But limited to 10 rupees means they have to pay at least up to 10 rupees. So since now they have become shareholders, first money becomes due from them. As and when we ask the money, it becomes receivable. Okay. So allotment money becomes receivable, debit the receivable, share allotment account debit. I repeat, allotment money becomes receivable, debit the receivable, share allotment account debit, and we transfer it straight away directly to share capital account. Now why do we transfer it directly to share capital account? As I said, they have become shareholders. Shareholders means the owners. So if we ask the money, they are the owners, they are definitely going to pay. So we are sure they are going to pay the money. Directly you can treat it as your share capital. So here, as we ask the money from them, in our books of accounts, we show money is receivable from them, debit the receivable, share allotment account debit, and simultaneously we call it as a share capital of the company because now they are the shareholders. So as the money becomes due, it becomes their liability to pay to us. We immediately transfer it to share capital account. Okay. And then once we ask the money, after that they will pay the money. So on receipt of allotment money, on receipt of allotment money, now when we receive the allotment money, then bank is the receiver, debit the receiver, bank account debit, leave one line in between. I repeat everyone, leave one line in between. Okay, bank is the receiver, debit the receiver, bank account debit, after bank leave one line. Now this share allotment money is received, so no more amount is receivable. We don't have any amount receivable to be standing in our books, so we have to close this account. This which was debited earlier, to close it we reverse and credit it to share allotment account. Okay, earlier share allotment account was debited, it was receivable. Now we have received, it is no more receivable, so to close it we reverse and credit. Now if you all remember, we studied in the previous portion that there will be some odd man out shareholders who might not pay the money. And what do we call that as? Calls in arrears, if anyone does not pay the money. So if anyone has not paid the money, then calls in arrears are still receivable, debit the receivable. For that amount we will debit calls in arrears. That's why I made you leave one line in between. So calls in arrears account debit to share allotment if the money is not received. We'll be passing a combined entry. Bank account debit with the money received. Calls in arrears account debit with the money not received. And total amount we will credit to share allotment account and close it. Okay, so these two entries are of second installment, that is allotment. Now all of you will notice one thing, and this is a trick to remember the entries also. In application, first we receive. In application, first we receive, then we transfer to share capital. Okay, repeat it this way. In application, first we receive the money, then we transfer to share capital. But in other installments, first we transfer to share capital, then we receive the money. It's reverse. In allotment and call, it's reverse. So it's a trick to remember. In application, first we receive the money, so bank to share application, then we transfer to share capital, so share application to share capital. And in case of allotment and other installments, first we transfer it to share capital, so share allotment to share capital, then we receive the money, so bank account debit to share allotment account. Okay, so this is an easy trick how you can remember the things. In application, first we receive the money, and in allotment and other installments, first we transfer to share capital. Okay, so this is how you can remember the things easily. Now, fifth, on call money due. After allotment, the next installment is call money due. The entry will be exactly same as allotment, like two entries of allotment. I told you in allotment and call, now they are shareholders. So when we ask the money, it will become receivable, and later on they will pay the money after we ask from them. So as we pass these two entries of allotment, exactly same way two entries of allotment, like we had share allotment to share capital, now we will have share call account debit to share capital account. Okay, first we will transfer the money to capital. Reasons: share call money is receivable. As soon as we ask from them, call money is receivable, debit the receivable, so share call account debit. And as they are now the shareholders, immediately we transfer it to share capital. After asking, they will pay the money. So on receipt of call money, exactly same way like we pass the entry for allotment, fourth entry, bank account debit, calls in arrears account debit. Now instead of to share allotment, we will have to share call. So all of you write down bank account debit. Bank is the receiver, debit the receiver, bank account debit with the money received. If any money is not received, then calls in arrears are still receivable, debit the receivables. So calls in arrears account debit with the money not received. And share call account was debited, so to close it, we will reverse and credit to share call account. Okay, so these two entries are for call installment. Third installment, that is call. Now in case if there is first call, second call, third call, then accordingly 7th, 8th, 9th, 10th entries will keep on increasing. There can be maximum 3 calls. You'll just add the prefix share first call account debit to share capital account, bank calls in arrears to share first call. Same way if it is final call, then share second call or final call account debit, then bank calls in arrears account debit to share second or final call account. Okay, so what is the shortcut you all will remember? I repeat it again. In application, okay, remember this. In application, first we receive the money, okay, and in the second entry we transfer to share capital. Whereas in allotment and calls, okay, this is a shortcut how you can remember the things. In allotment and calls, first we transfer to share capital, then we receive the money. So very easy for you to remember the entries this way. In application, first we receive the money, so bank to share application, then we transfer to share capital, so share application to share capital. In allotment and calls, first we transfer to share capital, so share allotment to share capital, same way 5th entry share call to share capital. Then we receive the money, so 4th entry bank to share allotment, and 6th entry bank to share call. Okay, reverse of application. In application, receive, then transfer to share capital. In allotment and calls, reverse. first transfer to share capital, then receive the money. So it's reverse. Okay. If any money is not received, that will go to calls in arrears. Also, before the word shares, you can add the prefix equity or preference depending on which type of shares are there. Mostly 99.9% they will be equity shares only. So these are the entries for issue of shares at par. Now we can study the concept of premium. So give the heading B at premium, or second part at premium. As I explained you that premium means we collect the money over and above the amount of face value, means the shares are issued at an amount more than face value, more than 10 rupees. Now this premium is capital gain for the company. Okay, all of you keep writing it. Capital gain means one time profit. When the company issues the shares, then only it gets this premium. It is not revenue, it is not recurring. You don't receive this money every year like your income of sales. So it's capital gain. By the rule, credit all incomes and gains. We have to credit this. And you have to credit it to which account? To a specific account called security premium account. Okay, for all the securities, shares, debentures, bonds, whatever company issues at premium, in the ledger book we maintain only one account, which is called security premium account. So whatever amount is collected for premium, it will be credited to which account? Security premium account. Now premium can be collected with any installment, means premium can be collected either with application money, or with allotment money, or with call money. It can be collected with any installment. Okay, it can be with any one, any two, or all the three also. If premium is, let us say 10 rupees shares issued at 25, 15 rupees is premium, about 10 rupees what we are collecting over and about 10, 15. Entire 15 you can ask from application, with application, or 10 you ask with application, 5 with allotment, or 5 with application, 5 with allotment, 5 with call. So basically premium can be collected with any of the three installments, application or allotment or call, or any two or maybe all the three. Now what you have to remember is we have to credit security premium account, and it will affect the second entry in case of application where you transfer to share capital. In this entry premium will get credited further. However, in allotment and calls we transfer to share capital in the first entry. So here premium will get credited. Okay, here premium will get credited. And in case of allotment money also, call money also, in the first entry along with the share capital premium will get credited. Okay. So I repeat it again, you will be including the premium with the entry of transferring to share capital. Means in application you will include it with the second entry, but in allotment and calls you will include it with the first entry. Okay, so keep this in mind everyone. Now, how will we pass these entries? Understand it. If premium is with application, if premium is with application, then as I said to you, it will affect the second entry of application where we transfer to share capital. So that second entry will become share application account debit to share capital account with the amount towards face value and to security premium account with the amount received towards premium. Okay, with the amount received towards premium. So which entry? This one, second entry. In this entry share application account debit to share capital to security premium. Of course, if there is oversubscription and refund to bank account will come as it is. But in allotment, this entry is going to get affected. Share allotment to share capital. So if premium is with allotment, okay, if premium is with allotment, then it will affect the first entry, not the second entry, first entry of allotment. It will become share allotment account debit to share capital account with the amount towards face value, and to security premium account with the amount received towards premium. Now exactly same way, if it is with call, if premium is with call, okay, if premium is with call money, then again it will affect the first entry of call. Means which entry in the call? This first entry, fifth entry, share call to share capital, that will become share call account debit to share capital account with the amount towards face value, and to security premium account with the amount received towards premium. Okay, so you just remember the shortcut. In which entry we will include the security premium? Where we have the entry where we have share capital. In that entry we have to include it. In application we have share capital in the second entry, so we'll include it in the second entry. And in allotment and calls we have share capital in the first entry, so we will include it with the first entry. Along with share capital you will credit security premium, share capital with face value, and security premium with the amount of premium. Okay, so students, today we have done the basic entries of issue of shares. Okay, we have done with issue of shares at par for cash as well as at premium for cash. Now in the next lecture we will be taking up with the questions on this basic entries. Once the questions of this basic entries are clear, we will go to the second part, that is forfeiture of shares. So all of you revise these entries properly, learn them by heart. I have given you the tricks. In application, first receive, second transfer to share capital, and in allotment and calls reverse. First transfer to share capital, then receive. If they are issued at premium, credit security premium account. In which entry? Where we have share capital. So remember these basics. Okay. Bye everyone. Have a nice time. Thank you.